Hello and welcome to another episode of Monday Markets. As always, we're brought to you by Woo. Links available in the description below. Be sure with any exchange not to keep any more funds there than you need for trading, and always diversify your counterparty risk and don't put it all in one place. Although at this juncture, I would completely understand if you're not interested in centralized exchange trading whatsoever, because volatility remains in a particularly miserable place. So one way to visualize that is by looking at the volatility index from Deribit. And it's really the larger trend that's more important here, but certainly since June and in this summer lull, it's been particularly miserable. Other indicators, like if you use Bollinger Band width or whatever else, we are really compressed and really miserable at this point. So if you factor in the size of the rotations on BTC and ETH, and then also consider your trading fees, it's really, really hard to just make money short-term trading in this market. You need to be really precise, and the opportunities are far and few between. I'll save us the time of going over every single high time frame because they just haven't moved enough, and we'll simply revisit last week's most pertinent time frame, which was the daily. Also, before I get into that, hopefully I sound less bathtubby. I played around with my audio. If it's better, let me know. If it's worse, I'm going to be very upset. Anyway, let's discuss the BTC daily time frame. If I recall correctly, last week we were talking about this potential swing low, range low here at 28.8, and the ubiquitous cluster here at the 29.8 to 30k, and unfortunately the market is still stuck there. So as far as from range low to range high, that's 3 to 4% from wick to wick, and that is really, really not much. And from last week, the only thing that's transpired is that we went from the range low to the range high, rejected, and now we're stuck in the middle. So really nothing to write home about. Sometimes if the daily market structure shifts, you can extrapolate that and make arguments for the weekly and the monthly catching up. You can do the same on intraday timeframes, like, okay, this is a 4-hour market structure shift, and then, or a breakout or whatever, and that might sort of push the daily and the weekly timeframes in line if it continues. On this occasion, we have absolutely nothing. That same daily range is the same 4-hour range, and that's where the market is for the time being. The thing is, we've had no shortage of headlines during this time, as we discussed on Casual Friday. Leave a like on this video if you enjoy that series, or this one for that matter. But we've had lots of headlines, but none of them have been important enough to just lift vols. The market's still very happy where it is and sort of ambivalent to headlines, which makes me think at this point it's going to have to be something ETF related, something very, very significant, because the smaller impact, less important news is just not having any market impact whatsoever. So really, if your argument at this point, you came to me and said, I'm just not going to trade on centralized exchanges, certainly not BTC and ETH, until I see a high time frame range break or a reversal in vols, I think that would be a completely reasonable position. I know it's tempting, as we've covered before, especially as a content creator, to come in here and start drawing out ranges on increasingly lower time frames and every support resistance level, but at a certain point you always have to concede that the market is just very balanced, and that balance is taking place in a very narrow range, and that doesn't make for a particularly attractive trading environment. Even if the market is going sideways, if the range in which it's going sideways is big enough and the market is responding well to those extremities, you can trade that. But at this point, with a 4% range from wick to wick, and the time spent there is very little, and most of the price action is sort of diddling in the middle, it's very hard to make good faith arguments for positioning within a 3 to 4% range. Okay, so interesting ways in which this might shift. I still think, even within the current restrictions that we face on the daily and the 4-hour, if you will be punting within these parameters, it's better done at the extremities, so in or around the range high and in or around the range low. The reason I'm not particularly interested is because, again, the range is just too small and it's almost not worth it. And the other argument is, I think eventually vol will lift. And I think the probability of that happening as we approach some of these ETF deadlines and the kind of summer lull, summer holiday runs out, I think it'll be a decent time towards the last quarter of the year for volatility to pick up. One reasonable and hopefully helpful point I can make is that if and when, most likely when, unless we stay here for years and years, if the market, or rather when, finally chooses direction and resolves this entire sort of range-bound environment and downward drift in volatility, I have no interest in fading that initial impulse. So in the past, we've described the sort of architecture of how a lot of these trend-forming moves take place. And often once you get the breakout, even if you miss the breakout day itself, there's quite a bit of continuation, right? So even if you look at how price made its way pretty much from 15 to 30, it's not a kind of steady incline, if you will, but rather it's a few outlier days that are responsible for most of the gains, right? And most of the time, when you get one outlier day in terms of momentum, volume, volatility, whatever metric you want to use, it's quite common that the market gives you another one, right? So in many cases, these outsized returns were followed by price action in the same direction, right? Works to the downside, works to the upside, whatever. So my expectation, applying that to the daily time frame, would essentially be, in the most simple terms, to wait for a candle like that and then give yourself a chance to position for continuation in the following day. So at the moment, we don't have a candle like that. The current structure, again, is quite depressing. Whatever green day we do have, full retraces the next day, but not enough to break the range that it's in. So pump's getting faded, but no one's just willing to step on this thing and force continuation. So I'm looking for an outlier type of day to see if it's going to offer another one, essentially. And more broadly, again, my parameters for this range are sort of 28.9, 29K-ish range low, and the same 30K range high. And until the daily, at the very least, shows me compelling evidence of that range breaking, this 4% is just really not worth bargaining for, in my opinion. But yes, in terms of the more practical element, I think if you get a range break, it's worth giving it a chance and not stepping in too early. I certainly have very mixed recollections about the range break in 2018. So that was the 6K break that took us all the way to 3,400 or whatever it was. And I'm sure you can dig up some tweets if you wanted to, good takes, bad takes, or whatever. But one of my compelling arguments, or main arguments at that point, was, look, we went sideways for so long, we've just broken down. Instead of trying to catch the knife at 5.8, 5.4, 5, whatever, why don't you just wait for it to get above 6K, and that'll be an easier trade? And I think that ended up being quite true, because even if you started averaging in here, the chances that you survived that 50% decline and then all this sideways on top of that took a lot of traders out. So in terms of applying that to the current framework, I wouldn't rush to fade the market if it looks like the volatility is coming to a resolution, and that would look like a large outsized daily or ideally weekly move, and we're just not having that at the moment. Even looking at the current weekly time frame, these candles have no bodies, and it's just not there, really. So not much else to add on BTC, as you'd expect. Same levels, same ranges, but hopefully some helpful higher time frame context so you know how to interpret the eventual volatility resolution. As far as ETH goes, it kind of looks even more pathetic, to be honest. I'm not going to bore you with the weekly, and even the daily just really isn't doing much. I could, of course, start superimposing levels on this thing and just drawing stuff, but I don't think it would be particularly helpful. There's really not much to say as far as ETH goes. At least BTC has the the goodwill to offer you some sort of trading range, even if it is a miserable 4% range. ETH doesn't even afford you that luxury, which is the word I was looking for. And this range can't even be broken down in, a similar simple style. So no interest in ETH whatsoever. A lot more flushy through the lows, but a sort of common pattern has been, even if we get these overnight dumps, which are good catalysts for a reversal, these sorts of wick moves that happen in the overnight session, in the normal market would give you some fuel to the upside or a bit of a squeeze. But on this occasion, or in the market more generally, any significant breakout looking or upside moves or deep wick moves that we've had essentially mean revert way far more quickly than you'd reasonably expect. That's the case with BTC and certainly the case for ETH as well. So, if you have very strong ETH views, leave them in the comments. I'd be interested to see what your arguments are. I could certainly be missing something, but if I'm missing something, it can't be particularly compelling, at least for my trading system, because this isn't exactly screaming opportunity to me. Nothing new in ETH BTC either. As far as the legacy world goes, where are we? Yeah, so if we go from the monthly, we're still in this rather precarious area. This is the chart that I tweeted, I think, with sort of 45 to 4,600 as being somewhat troublesome. The market's stopped there, but it hasn't done anything too scary yet. And in general, as we've discussed in the past, these legacy correlations are so hit and miss, mostly miss, and they haven't been helpful. So they've only presented a headwind up until this point and never a tailwind. If legacy pulls back and to reasonable support levels, that would look something like 43 to maybe 4,400 would be palatable. It just depends how crypto stands up in the face of that. For the time being, nothing too scary. We did note on Casual Friday the break of market structure that took place below 45s, and that still seems to be in effect. I wouldn't put too much weight in a daily trend shift so far, but it is there, and legacy weakness would certainly affect crypto, which wouldn't be great. The only altcoins that I've sort of promoted to the Altcoin Thursdays tier are the ones that have been relatively strong and or the ones at good levels. Not particularly looking for anything at the moment. I just want to have them on my radar. So if the market starts to look very strong or look very weak, I can check out where a lot of the open interest built up or where the recent participation has been to look for trades there. But Pepe is one sort of decent rally off the lows. It's better than nothing. Already reached a kind of short-term daily trouble area at 142s, but nothing opportunity-wise there at the moment. Just again on my radar because it's been going up. Sheeb is being heavily shilled on some Shibarium narrative that's supposed to be coming up, and I'm generally a big fan of buy the rumor, sell the news on hyped normie narratives. This time could be different, but this is done quite well off the back of that narrative from the lows. And so I expect a lot of participation to come in, expecting that the day of the narrative or the launch, whatever it is, that there are going to be late participants to these news catalyst type of trades. And I'd be looking to take advantage of any inefficiencies there, late buyers getting dumped on type of thing. So that's on my radar. And the only other one is XRP, purely based on technical levels. There is a weekly structure here that Don actually brought up on Casual Friday, which is some version of 58, just under 60 cents, depending on how exactly you want to anchor it. Again, if I get some sort of risk-on signal from the bigger boys, or if someone just trades at very piss-poor prices around here, that might be worth a punt. But to be completely candid, I'm not putting a ton of effort and mind share into high-cap alt setups at the moment, which shouldn't surprise you. If my view on BTC and ETH is absolutely neutral at best and volatility remains damp, I'm not going to crank up the leverage on altcoins unless I have a compelling reason to do so from the majors. So that's really the state of affairs there. I did want to bring up one thing that people asked for in the last Monday Markets video, and I will probably at some point attempt to do a larger scale educational piece on this. But just for the time being, this is what my Velo terminal looks like. You can build one out on Coinalyze, and Velo is currently free, although I think they're going to be paid later, whatever. And honestly, I don't use this for a ton of short-term active trading in this environment. But if I want a quick overview of the market, or if I am looking at lower timeframes, usually the 5, 10, 15 minute, or I'm looking for signs of participation at the higher timeframes levels I want to trade, is essentially going to be the following stuff. I believe this is open interest, this is spot and perp CVD, these are liquidations, and this is some measure of tape speed. Again, I'll eventually go into more detail as to how I use each of these. It's not terribly complicated. I'm just looking for contextual clues at high time frame levels. These on their own do not mean anything. I need to see what the market is doing at the high time frame levels to give me some sense of whether it's a good buy or a good sell. So for example, at some occasions, you'd want to follow or track the open interest as the market starts to buy ahead of a big narrative. Other times you'd want to fade open interest flushes, where a lot of people get liquidated, and you can see the open interest flushes line up with the liquidations as well, which makes sense because liquidations are forced closures of positions, and when those positions get forcibly closed as opposed to exchanged with another party, that's going to be reflected in the open interest. So those are some interesting dynamics that are worth paying attention to. Classic, cumulative volume delta between spot and perps, just to get an idea of who's being aggressive, who's leading the rally, at which point in the rally are perps getting sort of extra aggressive relative to spot. Is it one of those spot-led pumps and then perps pile in late? Or is it a perp-led rally that is usually a bit more jumpy in terms of, those participants are going to get washed out on lower time frame moves, whereas the spot traders tend to have slightly deeper pockets and are more resilient to low time frame volatility. Divergence between spot and perps, all that kind of stuff can become contextually quite interesting. Sorry for the skip, the recording ran out there. Yeah, so as I was saying, I'm not looking for multi-tiered entry systems or some sort of confirmation trigger. I'm basically looking for some outlier indicator that there's a lot of voluntary or in some cases involuntary participation at those high time frame levels or even intraday levels, and that can come in many different forms, either trading with open interest, fading open interest, looking at the relationship between open interest and liquidations and either fading those liquidations or seeing that there are more people left to liquidate if the market is rallying and the open interest is being stubborn. Tape speed just for sort of exhaustive rallies and looking for buying and selling climaxes, and CVD to see who's in charge and which participants, be it spot or perp, are getting more aggressive or de-risking earlier at those key inflection points. If you go on my Twitter, on CryptoCred, there is in that pinned document that I've got a funding and open interest guide of sorts there. That'd be a good place to start if you want to get a sense of how to interpret some of that data. I know that was brief, but just wanted to give an overview of this and more in-depth content coming on that eventually, I suppose. I'm not going to lie and say soon, but eventually. But again, boring markets, I thought I'd throw some of that in. That's all I've got. As always, thank you for watching the show. Leave a comment, like, subscribe, all that stuff. And Woo somehow still gives us money to make this show even when the market's dead. So thank you to them. Be sure to check them out if you want to diversify your exchange counterparty risk and not trade all in one venue. That's all from us. Thank you. And from me, rather, and the voices in my head. And I'll see you next week.